What if one of the world's most respected macro investors is right about what's coming next? While most investors are still focused on market crashes, recession fears, and crypto volatility, Raoul Pal believes something much bigger is happening behind the scenes. According to Pal, the recent sell-off may not have been the beginning of a bear market. Instead, it may have been the final stage of a liquidity squeeze before a massive wave of new money enters the global financial system. And if he's right, the implications could be enormous. We're talking about trillions of dollars in potential liquidity. Changes to banking regulations, rate cuts, government stimulus, the rapid growth of stablecoins, and a financial system that may be quietly preparing for its next major expansion. For years, Raoul Pal has argued that liquidity is the single most important force driving markets. Not headlines, not politics, not even earnings. Liquidity. And today, he believes multiple forces are aligning at the same time in a way that could reshape the future of crypto, stocks, and the global economy. But is this truly the setup for the next great bull market? Or is it simply another optimistic prediction in an increasingly uncertain world? To answer that question, we need to understand the hidden system that drives everything. Because beneath every rally, every crash, and every financial cycle lies one powerful force that most people never see: the flow of money itself. What if the biggest crypto crash wasn't a warning sign? What if it was actually the signal that one of the largest liquidity waves in modern financial history was about to begin? While millions of investors were panic selling, watching portfolios collapse and wondering if the bull market was over, a small group of macro investors were quietly reaching the opposite conclusion. They weren't asking how much lower prices could go. They were asking how much liquidity was about to enter the system. Because throughout history, markets have often moved not because of headlines, not because of politics, and not because of investor emotions. They move because of money. And according to one of the world's most respected macro investors, the financial system may be preparing for a flood of it. If he's right, the recent pain may have been nothing more than the setup. And what comes next could reshape crypto, stocks, bonds, housing, and the global economy itself. Mystery for months, investors have been trying to understand the same question. Why did crypto collapse so violently? Was it simply another speculative bubble bursting? Was it proof that digital assets remain too risky? Or was something much larger happening beneath the surface? Because while most people were focused on falling prices, a different story was unfolding deep inside the plumbing of the financial system. A story involving government debt, bank regulations, treasury markets, stablecoins, and trillions of dollars that may soon be injected into the global economy. The mystery is not whether crypto crashed. The mystery is whether that crash was actually the final cleansing event before a new phase begins. To answer that question, we need to understand a force that most investors rarely think about: liquidity. Context: every financial market depends on liquidity. Without it, nothing works. Liquidity is the fuel that keeps the economic engine running. It allows banks to lend money. It allows businesses to expand. It allows consumers to spend. And it allows investors to take risk. When liquidity expands, asset prices often rise. When liquidity contracts, markets struggle. This relationship has repeated throughout financial history. Yet most investors focus on earnings reports, economic data, or political events. Meanwhile, professional macro investors often focus on one thing above everything else: the flow of money through the system. And according to this view, crypto has become the purest expression of liquidity on earth. Crypto reacts faster than stocks, faster than bonds, faster than real estate. When liquidity enters the system, crypto often surges first. When liquidity disappears, crypto often crashes first. Which brings us to what happened during the recent market collapse. At first glance, it looked like a typical crypto disaster. Prices fell rapidly. Leverage exploded. Fear dominated every conversation. But some investors believe the crash had far less to do with crypto itself and far more to do with a temporary liquidity shortage inside the financial system. First insight: the first clue appeared in an unlikely place. The US Treasury. According to this theory, liquidity was quietly withdrawn from the financial system through movements involving the Treasury General Account. To most people, that sounds like an obscure accounting detail. But inside financial markets, these movements matter a lot. When liquidity leaves the system, risk assets often feel the pressure first. And because crypto is exceptionally sensitive to liquidity changes, it became the first casualty. The result was brutal. Leverage was wiped out. Positions were liquidated. Investors were forced to sell. The entire market seemed to implode. But here's where things get interesting. What if that collapse wasn't a sign of long-term weakness? What if it was simply the result of a temporary liquidity vacuum? A sudden air pocket. A moment when money disappeared from the system faster than investors expected. Because once the liquidation wave passed, something unusual happened. Prices stopped falling. Markets began stabilizing. Some assets refused to make new lows. And then, seemingly out of nowhere, certain cryptocurrencies started rising 20 to 30% in a matter of days. For some observers, that was the first sign that the worst may have already passed. Deeper twist: but the real story wasn't happening in crypto markets. It was happening inside the banking system. The financial system began flashing warning signs. Money market rates became volatile. Funding markets showed signs of stress. Banks appeared increasingly constrained. And according to some analysts, the Federal Reserve knew it. This created a problem. Banks need liquidity to function. They needed to manage balance sheets. They needed to refinance obligations. They needed to keep credit flowing through the economy. Without enough liquidity, the entire system becomes fragile. Which meant policymakers had a choice. Allow financial conditions to tighten further. Or intervene. Most investors immediately think of quantitative easing whenever liquidity injections are discussed. But that's not where this story becomes interesting. Because the next phase may not be driven primarily by the Federal Reserve. Instead, it may come from somewhere else entirely. The US government. Big explanation: this is where the story takes an unexpected turn. Behind the scenes, regulators introduced changes involving something known as the supplementary leverage ratio. A complicated name for a rule that influences how banks manage their balance sheets. Most people ignored the announcement. But some macro investors viewed it as one of the most important developments in years. Why? Because it changes how banks treat US Treasury bonds. For years, regulations effectively penalized banks for holding large amounts of treasuries. The intention was to reduce risk after the financial crisis. But over time, those rules also limited the banking system's flexibility. The new changes reduce that burden. Which means banks can potentially hold more treasuries. And that matters because the US government needs buyers for its debt. Lots of buyers. The government continues issuing massive amounts of treasury bonds. Someone has to purchase them. Now banks are being given greater capacity to do exactly that. But the implications go much deeper. Because banks don't simply buy assets and leave them untouched. Banks use those assets as part of a larger lending process. They create credit. And credit creates money. In other words, every dollar of additional lending capacity can ripple throughout the economy. This is where liquidity begins to expand. And according to some estimates, the impact could eventually reach several $1 trillion. Not millions. Not billions. Trillions. But here's where things get even more interesting. This may only be one source of incoming liquidity. Rate cuts could provide another. Lower interest rates make borrowing cheaper. Cheaper borrowing encourages economic activity. Mortgage rates decline. Business investment increases. Consumer spending improves. The economic engine begins accelerating again. Then comes fiscal stimulus. New government spending programs. Tax relief measures. Additional deposits entering the banking system. More fuel entering the machine. Individually, each factor matters. Together, they could create a powerful liquidity surge. And then another major force enters the picture. Stablecoins. For years, stablecoins were viewed as a niche corner of crypto. Today, they may be evolving into something far more significant. Every stablecoin requires backing assets. Many of those assets are US Treasury securities. As stablecoin adoption grows globally, demand for Treasury assets may grow alongside it. That creates an entirely new source of demand for government debt. People across the world can effectively gain exposure to dollar-based assets through stablecoins. And in doing so, they indirectly help support the Treasury market. The implications are enormous. Because stablecoins may become a bridge connecting traditional finance, government debt markets, and the crypto economy. A bridge capable of channeling liquidity across the globe. And the story doesn't stop there. China is increasing stimulus efforts. Japan continues aggressive fiscal spending. Governments around the world are searching for ways to support growth. One by one, major economies are injecting liquidity into their systems. When viewed individually, these actions appear unrelated. Viewed together, they begin to form a pattern. A global shift toward greater liquidity. Risks, of course, every powerful thesis carries risk. The future rarely unfolds exactly as expected. Inflation could return and force central banks to remain restrictive. Economic growth could slow unexpectedly. Government debt concerns could intensify. Regulatory changes could face delays. Stablecoin adoption may grow slower than anticipated. And financial markets have a habit of humbling even the smartest investors. Liquidity alone cannot eliminate uncertainty. Nor can it guarantee higher prices. History is filled with moments when investors became overly confident. That possibility must always be considered. Powerful ending, yet one question remains. What if the recent crash wasn't a story? What if it was merely the prologue? Because beneath every market cycle lies a hidden force. A force stronger than fear. Stronger than headlines. Stronger than investor sentiment. Liquidity. And if the world is truly entering a period of expanding liquidity, then the consequences could reach every corner of the financial system. Crypto. Stocks. Housing. Government debt. Everything. The investors who understand that shift early may see opportunity where others see uncertainty. The ones who ignore it may spend years wondering how the next major move happened so quickly. Because by the time the crowd notices the flood of money, it may already be too late. And that raises a fascinating possibility. Perhaps the real question isn't whether the game is on. Perhaps the real question is who recognizes it before everyone else.